I'm Laura Valestin, and this is PwC's Tax Insights in Brief. On December 10th, Treasury and the IRS released final and proposed regulations related to foreign currency translation gains or losses arising from qualified business units, or QBUs, that operate in a currency other than the currency of their owner. The final regulations retain the basic approach and structure of the proposed 2023 regulations, with some revisions. The final regulations retain the FEAT method and the current rate and annual recognition elections. They still apply to previously excluded entities, such as banks, insurance companies, RICs, and REITs. The final regulations provide that Section 988 transactions are determined at the QBU level and not the owner level, and include a new 988 mark-to-market election for QBUs, similar to the 988-7 election. Partnerships and S corporations are generally not subject to the final regulations, except with respect to certain provisions, such as suspended loss rules, deferral rules, character and source rules, and partnership basis adjustments. The regulations provide a simplified computation more akin to the 1991 method for taxpayers that make the current rate election and for applying the pre-transition default calculation. Further, if a taxpayer applies the pre-transition default calculation, the taxpayer only has to go back to tax years beginning on or after September 7th, 2006. While the regulations still include the suspended loss rules, they provide for a look-back period and a de minimis rule. The final regulations generally apply to tax years beginning after December 31st, 2024, consistent with the 23 proposed regulations. Additionally, the final regulations retain the retroactive applicability date for terminating QBUs that terminate beginning on or after November 9th, 2023. The proposed regulations provide an election for taxpayers to translate a group of frequently recurring transfers between Section 987 QBUs and its owner, using the yearly average exchange rate rather than the spot rate applicable on the date of each transfer. They also would modify the computation of unrecognized Section 987 gain or loss for taxpayers that make this election. Treasury and the IRS have requested comments on several items relating to the application of 987 to partnerships and CFCs. Companies also should consider providing comments on the proposed regulations, which are due by March 11th, 2025. As the regulations generally apply to tax years beginning after December 31st, 2024, companies should model the overall impact of the final regulations on their QBUs with and without these new elections, as the elections would affect both the quantitative results of the regulations and the data required to be tracked and maintained. Companies should work with their auditors and tax accounting specialists to evaluate the potential financial reporting impact of the final regulations and the proposed regulations. For more details, read the attached insight. Thanks for watching. This has been PwC's Tax Insights in Brief.